surprising and interesting. But today we're going to be talking about, what's going to break first, inflation or the economy. It's going to be a really good topic. First, let's just get into our Twitter questions of the week. Can you ask, knowing what you know now, what advice would you give your past self on investing? And Norm said, don't be afraid of debt. Take the free money while it's still available.
Yeah, if it's free. So, yeah you're right. That's right, Norm. So, when it was 3% debt and the economy was, or I guess inflation was 2%, you were in a pretty good position. Now inflation's higher, obviously, out of 5-6%, let's say. So now it looks free. But you're right. Basically, debt is OPM. So I think a lot of times people don't realize the money in your wallet can be actually either equity or debt. It just depends on who you lend it and how you lend it.
Yep. And then our next comment came from Jerry's having some technical difficulties. Joy, she said, don't rush to invest. Focus on understanding and the concept of money and practicing the skill of making money. After that, invest. Even if the first few investments fail, I know how to make more money quickly and reinvest.
That's a good one. Even you.
Yeah.
She gets emotional on certain properties.
Not as much anymore.
Well, a couple weeks ago, she's like, I'm going to invest in this deal. And she goes, what do you think? Thinking that I was going to say, do it.
I still think that would have cash flowed.
No.
Anyways.
Be patient.
Next comment. I am Ari says, invest in the knowledge of investment and get a mentor.
Yeah, mentors are good. Especially, you guys should not go it alone.
Yep. Find
people that have done this. Get in those circles. Limitless is going to be packed with those folks. If you have money or you have access to money. Now, it was funny. I was having a conversation with somebody that has access to, they have some money and they have access to a lot of people with a lot of money. And they were talking about coming into real estate. And I'm like, why would you do that just because you have money? That makes no sense. Just because you now have access to it. So, you have to come in at the right time.
Right. Absolutely. All right. Before we get started, speaking of Limitless, make sure you go to limitlessexpo.com and get your tickets. It is in less than a month.
I know. I can't believe it. So this morning, I had an hour call with Chris Voss, who was one of my heroes. So, he wrote the book, Never Split the Difference. The number one leading hostage negotiator. He works for the FBI. He's taught at Harvard. He is something else, and he's got a master class and all this stuff. He's going to be one of our keynotes. I can't wait to hear his message. And what we talked about is that because you wanted to know the industry and what's happening, and I said, listen, I think people are they're going to hit some headwinds here, and so he's going to talk about how to negotiate during turbulent times.
Yeah,
which is, I think, where we're headed for lots of reasons.
Absolutely. All right. So let's jump into the topic. So it's been an interesting time here for a few different reasons. As all of you know, the government pumped a bunch of cash into the economy in 2020. And now, obviously, but clearly not obvious to them at the time, it created inflation.
Well, they did two things. One, they the Senate voted home. And then they gave businesses the PPP money and the EIDL money and then the STIMI money. So that was one. But then they also, if you remember, they reduced the federal funds rate to 0.
Right.
Okay, so those are two different things. One is giving people a bunch of cash, and the other one is making the interest rates basically 0. Not to say they didn't need it at the time, right? Because the economy, there was a lot of uncertainty.
Yep, absolutely.
So that's showing up now.
Well, and so what's interesting is it's the Fed's job to balance the economy and inflation. It's the only two things that they have to worry about.
And employment. Yeah.
Right. I'm sorry. Employment and inflation, which directly relates to the economy. You're right. So that's the only two things they have to worry about. Now, what's interesting is we've never had high inflation going into a recession.
Yeah.
Ever.
I know. That's why a lot of people are throwing conspiracy things out there. I don't know if you guys, but I'm completely confused as to, what's next. That's why I flew out to Rebel Capitalists. I listened to half a dozen economists. Then the next day, I flew to Nashville and met with CBRE National Conference and listened to more economists. And then, of course, we had our mastermind, and of course, we have a lot of really smart people there too. So everybody's trying to figure this out.
Yeah, and it's interesting because usually the job of the Fed's pretty straightforward. If we're heading into a recession, lower rates stimulate the economy, right? And if typically when we've had inflation, the economy's been booming and we had inflation, so it's higher the rates, slow down the economy. Right now, they're both happening at once. So the Fed is going to have to make a decision. What the Fed's hoping is that the inflation bubble pops before the economy. Because if the economy starts to break before inflation's under control, it's going to be interesting which one that they decide to do.
And I think it's important that people remember that this is really, really a key thing. In first quarter of 2022, so just about a year ago, federal funds rate was 0. So that's important to understand. So it's just been a little bit over a year that federal funds rate was 0. And why is that important? It's important because when money's cheap, it creates asset bubbles. It creates asset bubbles in the stock market. It creates asset bubbles in real estate market. And when they start to crank that back up, of course, then you start to see those bubbles deflate. And so that's what we're experiencing now, right?
Yeah, absolutely. So you're starting to see, you had easy money, free-flowing credit, and all that. But now it's time where the Fed is increasing rates to slow down inflation. But the issue is it hasn't really affected inflation as much as you would imagine. So I think at the height of inflation, we were at 8.5%. And now we're only at 4.9%.
Yeah, well, we actually hit 9.1, believe it or not, in June of 2022.
Did we? Okay.
Yeah, but 8.5 was the month right before. So when they raised rates, they actually went up a little bit. So yes, I know. To your point, people are feeling it. They're getting squeezed, and so the Fed, as they should, they've increased rates. There's a lot of criticism that they waited too long. And I think that's fair because they lowered them during COVID, which I'm not saying they shouldn't have. That's the last thing you want is people paying higher fees on things. But they didn't. They let that go for about 2 years.
Yeah. So
the Fed didn't do anything for 2 years, and that's what created. If you guys remember, that's what created these housing prices going up and all of those things. So now they're between a rock and a hard place here. What do they let fall? And I got to tell you, one of the things that I've been researching lately is that April had some of the highest bankruptcies for businesses on record in a long time. So things are starting to show up now. And of course, if there's any kind of debt maturing or, obviously on the commercial, which you guys know I've done a couple of videos on, if you bought something a year ago and it was 3% and it's gone up, which is floating rate debt or variable debt or whatever you want to call it, you're in trouble, whether it's a new construction project or whatever it is. And then the worst part on the businesses, as they're digging in a little bit more, think about this. Think about if you own a manufacturing business and you have that float, right, where you're selling stuff, and then you use a credit line. Well, the credit lines have gone up too. So the cost of your credit line has gone up. So there are businesses that are a little bit in trouble right now with the higher priced interest rates. So there's other. I mean, on this show we seem to tend to focus on real estate, and if you're in residential real estate, that's all you focus on. But there's really so much more going on. There really is, and that's what you got to pay attention to. The other thing is think about this. We had this weekend. people are asking me, what should we invest in? What should we invest in? Well, before you could invest in stuff that had a 4 or 5 or 6% return in year one. Now you just put them into government T-bills. So, you can get 5% completely safe at the bank. I mean, with the government. So, and so why is that important? That's important because that's a liability. If somebody's paying you 4 or 5% on your money, it's a liability. It's a liability for the bank. So the bank has these 3% loans, but they're paying 4 on savings, let's say. That's
right.
Not good. That math doesn't work. So so if they keep these rates high, we're going to see a lot more problems in the banking sector too.
Yeah, exactly. So it's really hurting the banking sector. And, it's such a balance between the inflation and the economy, right? Because what we're also seeing with people, because of the inflation, a lot to do with it, is, savings rates are at an all-time low. Credit card debt is at an all-time high.
Yeah, hit $1 trillion.
Yeah.
And so the average person owes $5,800. That's a lot at 20%.
Yeah.
That's crazy. That means that they're getting whacked. It's not good. People are using their credit cards to live, and that credit card balance keeps going up. I mean, this is the first time ever we've been in $1 trillion.
Yeah.
That's a big number.
Absolutely. So it's interesting because, but then those same people, because you have to think of the average person, because that's what the Fed's going to weigh, is the average person. So the average person, if the economy starts to go sideways and they lose their job, that's not good, right, for everything. If we have mass unemployment and people aren't spending money and it's too expensive to buy a home and they're losing equity in their homes and they're, none of that's good. But then for them with inflation, that's not good either, because they can't keep up and they don't have assets that move with inflation, and they're having bankruptcies and having a hard time buying necessities. So what will the Fed do? Because we are starting to see cracks in the economy. So they're trying to sugarcoat the economy, and we got that jobs report back it seemed a little bit suspicious.
Well, I think everybody's questioning it. The first quarter. So let's talk about this real quick. If you look, there's a bunch of criticism as to the way the BLS, our Bureau of Labor Statistics, is actually reporting this. And by the way, low unemployment from a Fed standpoint is bad, because low unemployment means wage growth, which is inflationary. So the Fed doesn't want low unemployment, and it's been in the mid 3s, let's call it, for a year. So, but there's two kinds. There's actually more than two. There's 6, but what the media picks up is what's called U3. Just Google this. Type in U3 unemployment. And on U3 unemployment, you're going to find 3.4%. On U6, which is what most people would consider to be the real unemployment rate, believe it or not, that doesn't ever get picked up, it's 6.7. So it's almost double. And what that includes are part-time, discouraged workers, or underemployed. So so it's not really capturing the real, what's really going on. And there's a lot of people really digging into this. And so what it feels to me like is that there's more unemployment around than is being reported, and also we have this high unemployment. And so what that means potentially is what the term that some of you guys have heard of is called stagflation. So stagflation is high unemployment and high inflation, and it's stagnating. So stagflation, stagnating. So the economy's stagnating, and that's actually what a lot of people are talking about right now.
Yeah, they are. And, so the Fed's going to have a decision. If you guys are enjoying the content, please make sure you hit the like button. It really helps us out trying to get to 100 likes. But anyway, so that's what people are kind of saying, is the Fed is going to have to do something, and they may lower rates to try to stimulate the economy,
which is inflationary.
And then they would just accept higher inflation, or they can keep pounding, lowering, the inflation, but that's going to pound away at the economy. You could have high unemployment, could have almost like a recession, depression situation. And so it's going to be interesting to see, what they decide to do. And nobody really knows. And something else Logan brought up that I think is interesting is, also with these banks being very unstable, that the more they up rates, the more pressure it puts on these banks.
That's right.
And then the bailout for these banks is also inflationary. Right. So, they're really fighting an uphill battle. And a lot of the inflationary things are things they're going to have a hard time with, like rents, because there's a supply demand issue, gas, because they're not, oil, because they're not getting it from here, and groceries, food and things like that. So they're really fighting a big uphill battle on prices of things that really aren't affected by rates necessarily.
Yeah. Well, so one of the reasons why we have 40 some speakers at Limitless next month, and one of the debates is what order you put them in, right? And because they're all amazing folks, and so we're starting off with Joseph Wang, who wrote the book called Central Banking 101, and he is on the open market desks of the Fed. Basically, was in charge of the bond buying and all the stuff that one of the things that the Fed does for this. So I can't wait to hear his presentation on this exact issue, because you're right. The Fed has to make a choice, and everybody wants rates to go down, including me. But the question is if you lower rates, which first of all, the Fed's not going to lower rates right away. The first thing that they'll do is not increase rates. That's the first thing. They're not going to go from all these increases to lowering. They're going to say we're not going to lower it at this time. So the next meeting with the Fed's going to be very interesting, because everybody thought, even on the last meeting in May, this month, that they were going to lower or stay neutral, but guess what? They went up another 25 basis points. So, which is better than, in the past, but 25 is actually pretty normal. That's actually what the Fed's known for. What they've been doing is 70.75 and 0.5%. So now we're sitting on these higher rates. I just think that if they do this, then we're going to see inflation again. And so it's very possible. Well, when I talked to Joseph Wang about what he was going to discuss at Limitless, here's what he's told me, which I thought was fascinating. He said, it's actually not that hard to get inflation from, say, 9 down to 6. It's really hard to get it from 6 to 2. So you can make a good impact pretty quickly, but then that last piece is really, really difficult. So I can't wait to hear what he says.
But the interesting part is that if they would decide, we're going to just focus on the economy, we're going to bring rates back down, the inflation, like we've gotten it to, 5, but it'll just like fire, just go way back up, when they start stimulating the economy again. And you went to an interesting meeting this week with CBRE. And why don't you let people know what the economist there said? Because I thought it doesn't mean he's right, but I thought it was interesting.
Well, I talked to George Gammon about it too, because George is one of my partners in the collective. So a couple things. One, it's funny because when you go to a real estate conference, which is the first thing I went to, especially when it's filled with owners and brokers and landlords, there's about 700 people there. I think it was in Nashville. It was CBRE's national conference. So they're pretty optimistic, obviously. Rates are going down, and, federal funds rate is going to be cut in half in a year. That was basically their projection. And I'm like, well, why? Mm-hmm. And the problem that the commercial industry has, and residential, is that if rates don't go down, then people are going to get further and further away from being able to buy a house, and some of that commercial debt that's maturing is going to go through a default. So their projection was that. But then they brought in this economist who basically it was looking at it from a geopolitical standpoint, which I thought was fascinating. So he was looking at it very differently, and he believes that inflation is going to be, over 9%.
Yeah. He believes they're going to just accept higher inflation.
Yeah, they're going to keep printing because they have to support the debt that the government is already in. You know, right now we've got this debt ceiling and all that stuff, and that's been a big debate, political debate for years. But he believes that they're just going to have to keep printing, just like Japan had to do, and so he's looking at countries and what they're doing, the ones with central banks at least, the ones that can print, and so. You know, it's interesting because then I asked George, I'm like, George, what do you think? Because he's looking at the inverted yield curve, and short-term rates, of course, are more attractive than long-term rates, which, by the way, is not supposed to be the case. So, you know, and even Jeff Snyder, who's brilliant, who I listened to, said that he thinks that rates are going to be down. So, boy, is my head spinning too. I hope they're down.
Right. I mean, it's just interesting because, and the other thing you do have to consider, and it doesn't mean the Fed's going to do this, but you do have an election coming up. So what the Democratic Party is going to want is high employment, low unemployment, a good economy. They're going to want that over, but they're also going to want low inflation, you know, so it's going to be interesting. There's going to be a lot of pressure on the Fed to lower rates, though, I do think. And, it'll just be interesting to see what they do. We're just going to have to wait and see. But they are between a rock and a hard place, and this is the first time they've ever been in this position.
I think you think about, like, my mom. Obviously, I'm going to take care of my mom, so before you guys jump all over me. But my mom's on a fixed income, okay? So whatever she gets each month, she's been getting for 10 years, right?
Yep.
It is what it is. So... this is who I think of. I think of people on a fixed income, and they start to make changes in the way they eat and the things that they do as a result of things going up. And we're hearing about it all the time. And it's starting to show up. People are starting to make different choices on, you know, maybe what was once discretionary. Their savings rates are down. So people on fixed incomes with high inflation are getting killed. It's horrible. And so I think that's kind of the everyday person, you know.
Right.
I mean, if you're retired and you're relying on some type of fixed income, this is a big issue. So I think if I were in their shoes, I would let real estate cave a little more, because that affects, you know, it affects less people than inflation.
Yeah. Yeah, I mean, it's going to be interesting to see, you know, kind of what they do. But you have to remember, though, that these rates affect people's credit card balances. These rates affect people's ability to get a car loan. These rates, you know, so it's not just people that own real estate. It's just people that want to own anything. And we are in a nation that not only do they rent houses, they rent cars, and they rent, you know, everything. They live on credit cards.
I think that's why the business bankruptcy issue is so big. If you're selling anything that's financed, you have less customers. Mm-hmm. That's actually a pretty interesting thing to say, right? So let me say that again. If you're selling anything that's financed, even a TV or whatever it might be, it doesn't have to be a car. And we talk about these big things like houses and cars. I'm talking about anything that's financed. Then it's become a problem.
Right. So, which is interesting. I mean, they really are between, either way that you look at it, the people that are getting the most hurt from either or, honestly, are the people that don't have assets that move with inflation and are trying to live just on one sole income.
The fixed incomes. That's why that's why there's so much scrutiny on rent. Mm-hmm. You know, if you guys take a look, I did a video Friday that talks about the difference between mortgage payment and rent. It's never been higher to have, I think it was $470 some difference between the cost to buy versus the cost to rent. Now, the only reason I did that is because it's a snapshot in time. I also believe that real estate investing and having all those depreciation and those tax savings that you get is the right way to go. But right now, the cost of home plus the cost of your payment is, $450 to $500 more per month on the average. And some markets are higher, some are lower, but that's the average. So right now, all that does is force people into rentals. And so what does that do? That puts more pressure on the demand for rentals, which of course drives up the cost of rentals. That's what it does. It drives rent. More supply, more demand, I should say, on the same supply. So we have a real problem here where people are displaced. People forget sometimes that residential and multifamily are not the same. They're not even close. So most people that can rent want to typically buy. And when they can't buy, they default into rent. That is the stark reality.
Yeah, especially as they get a little bit older.
Yeah.
Out of their 20s. So now we are going to jump into the questions of the week. If you guys want to become members, go to kensinnercircle.com. We answer all of your questions, some of them on here, some of them by email. And Steve's going to put that in the show notes. All right. So our first question comes from Chad. He's asking, is there ever a time to sell an asset? Too many repairs, neighborhood turns bad, negative population trend, etc.
All of those reasons. Yeah. No, it's a really...
You've sold
I have,
some properties.
yeah. I don't like to, but there are times where that does happen. For example, I remember I used to have some stuff in the Tri-Cities, which is Eastern Washington. And there was a plant there called the Hanford Nuclear Plant. So it was a nuclear plant, right? And they said there was all kinds of debate on this thing, but it ended up closing. But way before it closed, everybody knew it was going to close. So I'm like, let's get the heck out of here, right? So we had properties in the area because, again, it's a big employer. So when you have people moving out of an area for whatever reason, it could be a university shuts down. It could be a military base that closes, even though we haven't seen that in a while. I have seen that before, or they downsize, or there's budget cuts in the military. And those kinds of things affect rental markets.
Yeah, and you've even, especially nowadays, if the neighborhood or the area is not, crime, if it's crime friendly and that you're starting to have crime issues, that's a reason to get out too.
Well, look at San Francisco. I pick on that all the time because it's actually should be. I know plenty of people that they don't want their employees. They can't really walk to work. There's things that go on. There's safety issues, and I don't want to get in too far down that road. But the bottom line is there's a reason that San Francisco office buildings are over 30% vacant. Okay, so you do see those kinds of things, and so by the way, I don't know if you guys look, just Google this. In 2020, there was an office building in downtown San Francisco that was valued at $250 million. It just sold for, was it 70? 60. Just Google it. You'll see. It was on State Street. So how does an asset go from 250 to 70, let's say? Well, occupancy. And what happened with all the political nonsense, that's going on there. So, yes, there's a time to sell.
Yeah, absolutely. And if you're enjoying this content, make sure you hit the like button. We're 9 away from 100, which is what I wanted to get to. All right. So Michael, who's usually on, he's not on today, he had a question. And make sure, too, if you're listening on YouTube, you ask some questions. I'm going to try to answer as many as we can get to. So Michael said, if a commercial real estate office crash happens and the government purchases these assets and converts them to low-income housing, thus knocking down rents and the next domino for commercial residential, what are your thoughts on this likelihood?
So it's already started. The government's, I know, bought a number of micro hotels around the country. I know New York specifically. I had somebody that told me that there was 9. Now, believe it or not, that didn't make a huge impact, but it's basically converted into that. low income, and even actually they bought it. I might have been the city. I don't know if it was the state, but essentially that could potentially happen. I don't know exactly how you would move low-income housing into office buildings because you have plumbing issues and you have common area issues, and there's a fair amount of retrofit. So it's not just taking an asset over, but there's a cost to convert. So I'm not saying it can't happen, but it's definitely I think you're going to start to see it's going to be a long time before we see a recovery in commercial office. In fact, we've never seen these vacancies. Nationally, it's over 20%.
Yeah, but it's not going to be an easy task to just convert. It sounds so easy, right? Just take an office building, make it rentals, right? But it's so hard because you have, typically in an office building, you have one bathroom or one bathroom, a floor or whatever. And you don't have all the, like kitchen, like plumbing and bathroom plumbing. And it's not as easy. Like sometimes it's just easier to demolish it and start ground up.
Remember that we went biking in Venice Beach, and we rode by that hotel, 2-story hotel, an old brand that clearly the city of Venice had bought and had converted that, and you can tell from the all the stuff that was happening there, but that's easier, right? Because everyone can get their own room and it's all set up. It's got bathrooms and little kitchenettes and stuff like that. So it's a little more complicated when it comes to office building, commercial office.
Absolutely. So the next question comes from Ephraim. He's asking, as a new member with no funds to invest, what would be your first piece of advice to get me started? He's been looking and calculating deals on Crexi, Crexi, and he currently owns a law firm.
Okay. Yeah, I would not invest right now.
Mm-hmm.
I would learn as much as you can. I would watch as much as you can. I would go to as many seminars as you can. I would read as much as you can. And build your team and your network, and I would start to save some cash. So we're at the I would say I think we're at the first few innings of a 9-inning game here, and if it cash flows, like Danille's still looking, like she looked at a property this morning.
Right.
So
that would have cash flowed if it wasn't for the land lease.
There was a lesson there.
Yeah.
She was online last night and she went and looked at it this morning, and it was a quick no. So that's what I'm talking about, an education standpoint. But don't feel any pressure to invest this year. Just watch the markets, because I told her 2 months ago, I said, I think we should wait till the fall. She hasn't stopped. She's going to continue.
I just I just love to look, honestly. And I do think there can be some deals out there. But realistically, it's going to be hard to find one right now. But that doesn't mean you shouldn't be looking. And if anything, looking and going and seeing properties and just looking on Zillow and saving search results to watch as they go down. And the ones I'm looking at are going down. And also to get yourself familiar with the market. Like we had a member of the collective moving from Seattle to Arizona this weekend, and he was looking at a house, and Seattle prices are higher than Arizona just in general. So he's like, oh my gosh, this property 1.2, I'm kind of looking. And I knew that property was super high because I understand the markets. Because I look at, even though 1.2 is not even in my price range, I'm looking at like $600,000 and $700,000 houses.
For rentals.
I know that 1.2 for that is not that much nicer than the $600,000 rentals I've been looking at. So I was able to give him some advice. So if nothing else, you'll understand the market, because him just coming into the market is like, and his realtor's telling him, hey, this is a good deal. Everybody wants the house to sell, and it was priced high. So you really take this time and really act like a buyer and act like there's cash flowing deals and get really familiar with the market. So when there are, you understand it.
Yeah, I mean, Danille's still looking. It's tough. She has a tough time having cash, and she wants to invest it. So she's looking online all the time. And just in the last few months, you've learned a lot just by going out. Like today, she learned the lesson about land leases. So there's always something to learn. Also, the realtors or the people that are helping you look, you're going to get a different perspective from them too, as you're out looking, because they're the ones actually, the hardcore, showing units and listing units and that. So there's nothing wrong with that, but just be careful on investing.
Yeah, and you don't want to rely too heavily on your realtor. You want to know the market. You kind of want to know yourself and maybe get their opinion, but realistically, they get a commission, they're salespeople, so you really need to know it yourself. You don't want to just be relying on them to tell you.
Well, they're not looking at it as investing, because if they did, they wouldn't be showing it to you.
True.
So so just know that. Just know it's nothing wrong with that. It's a great industry and a great business, but their job is to sell you and get a commission and do it again. Your job is to make sure you buy something that cash flows.
I want to answer this question on YouTube. I think it's a good question. So Lydia is asking, we need to expand our square feet we live in right now. This is interesting. We'll rent our current house. And my guess is why they want to do that is they have a low interest rate on it. And that's part of the problem we're seeing. Is it buying new property for long-term reasonable right now? Or do you think it's not a good time to buy whatsoever?
So like I guess we just kind of talked about this, but I'm always looking. We looked at, I think I told you guys, we underwrote 14 deals. We didn't make an offer on one of them. My team is still active here. We're still looking for deals. I went to that conference. We're still looking for deals. There's still a big difference between bid and ask.
Well, but also they want to live in it. So it's like, if they're going to go live in it because they're trying to, upsize and they're going to rent out their place, it really comes down to, Lydia, if you can afford it. I mean, if you find a house, like we're all looking for rentals, it's a little bit different. If I was trying to move into a house, and we are actually looking at houses too, like you might want to wait till the fall, kind of see how things go. But at the same time, if you can afford the payment and you want to live there, then
just do it.
Just do it.
We look at that differently. I've got my eye on about 20 houses under construction, and these are right now they're listed, north of 10 million. And I just know that they're going to be in big trouble when there's no buyers.
Well, Running with Altitude just said that builders are also assisting with closing costs because they're in trouble.
But if you have a big custom, let's say, it's different. These are one-offs. So, but they're right. So also, when you be, on a track stuff, be careful because those rate buy downs are 1 year.
Right.
They're not like for the whole term of the loan. So be careful on that too, because the builders are doing that. But really what they're doing is they're just trading dollars and buying down the rate for the first year. It's just math.
Yep. So Eric wants to know from the inner circle, is there better asset protection to have a separate LLC to manage your properties from the one that holds the title?
So we get this question a fair amount. So the loan and the title will be in your name, and what you're trying to do is you're trying to protect the asset from creditors. That's it. So there's not a lot you can do with the loan. What you're trying to do is protect the equity that you may have in that asset. So what you would do is you would put that into an LLC. So it's really asset protection, if that makes sense, right?
Yeah.
So let's say you have a tenant in there and you have a fire and somebody gets injured. Well, they're going to sue who's ever on title. And if they sue you personally, then they have access to all your assets. But if they sue an LLC, they're actually suing a business, and then they have to do what's called pierce the corporate veil, and so your stuff's inside of that. And also, the biggest thing is that you're making sure that they can't have access to everything else, because maybe you have a personal residence, and maybe you have some investments and things like that. You want to make sure that they're suing that asset and not you, because you are the asset for everything that you hold. So that's I just want to make that distinction.
Yeah, and he's also asking too, would you need another LLC to manage the property?
No.
And I don't think so. I mean, I think that we're not experts at this, so consult, whoever, but
you just have an agreement with the LLC with the management company. So that's all. But doesn't have to be, but I think you have to be careful on the accounting, right? So you want the tenants to pay rent to the LLC, if that makes sense.
Yeah, absolutely. And Nate is asking from the inner circle, I feel like my money is burning a hole in my pocket.
Don't we all?
What should I do with it?
I know. I'm doing the 1 3-year T-bill, or 3 month, 1 year, or 1 month, 3 month T-bill. So if inflation truly is 5, let's say, or 5.5, what is the Fed saying?
It's saying it's like 4.9.
Okay.
Last month.
You can get more than that in a government-backed T-bill. So yeah, you're not moving forward, but you're not going backwards. So that's I would just park your money right there. Make sure your money's not sitting in a bank at 0. There's a lot of bank. I don't know if you guys have looked, but you should look at the M2 money supply of the banks. There's a lot of money flying out of banks right now. After those 4 bank collapses. So, banks are starting to get really competitive, and rates are going up. So just make sure you might not be beating inflation, but as long as you're hitting inflation, I think you're going to be fine for now. And that way, you won't lose any sleep.
Yeah, absolutely. Michael said, you can't forget baseball cards.
Oh, yes, of course. Gosh, I wish I would have had all ones.
So anyways, so John and Moretta asked a question from the inner circle. It says, on one of your recent podcasts, you mentioned how to fix your debt on your properties. We own commercial properties that currently have no debt on them. We may want to put debt on them in the future, but so far, none of the banks have offered fixed debt, only 10 to 20 with a re-rate in 5.
Yeah, so this is probably the worst time to go look for debt. You got to do it when times are really, really good. First of all, congratulations for not having any debt, because you are probably in the 1%. I would just stay right there for now. Let's let things fall as they may. We're actually in the middle of a credit crisis, a little debt and credit crisis right now. Banks are changing their underwriting, and this is really just a timing thing. So you want to look at when things become more optimistic for the banks and the economy's going the right direction. So I know they're out there. We do it. So but right now they're even we're having problems with getting specific kinds of debt, and I think that the banks are pulling back right now.
Yeah. And if you think about it, if you were a bank, why would you want to give somebody long-term debt knowing that you don't know what's going to happen with rates and borrowing? So it makes sense. Dennis from YouTube has an interesting question. He said, what's your opinion on the 100% finance deals for new construction property? It doesn't cash flow, but there are big tax benefits.
So a lot of this is going to depend on that. You said it doesn't cash flow, so you really have to look at that. If you're okay with that and you're saving a lot in tax, then it might be worth it. But man, at 20, I think residential is 27.5 years, so you really have to look at the trade-off. But I personally just have a rule that if it doesn't cash flow, I pass. Because I'd rather have both. I'd rather have something that cash flows and I get the tax write-offs.
Well, right, because you kind of told me that because I found a property that broke even. And I was tempted because I'm like, well, when the rates go down, I can refinance. And you said to me, and it's always right, and I say it to people too, if you think it's going to break even, you're going to be repairing it, you're going to have vacancy, you're going to be feeding it, and you're going to be pissed. And you don't know how long until rates do go back down and you're able to refinance it. It could be years.
Yeah, but you do have to, he brings up a good point. You have to really take a look at the whole picture. So if you have a huge tax issue, But you got to know if it's a new house and new construction, you're probably not going to have as much capital, all that kind of stuff. But you could have vacancy, you could have damage on the inside, you don't know your tenants, and you could have builders going out of business and warranty issues and things like that. So there are things that can come up. But I just like to have that cushion. I personally would pass. There are other ways to save on tax.
Yeah, absolutely. I think sometimes, and I'm included in this, we all have money that we want to invest, and you almost want to justify something just because you want to buy something, but you really need to wait for the right thing to come along.
And don't forget that, you want a bunch of dry powder, and you might have a bunch, but this is a good time to be heavy in cash. If you take a look at a lot of the experts are getting rid of toxic assets and building up their cash reserves.
Right. Absolutely. Brenda says, don't catch a falling knife.
Ah, yep. I need to get one of those, Jerry. We need to get that logo somehow.
So John is asking, and this is always a question, because I do feel like you always switch it a little bit, but what inning are we in for residential? I mean,
so it is true, guys, but I'm looking at, you got to understand, I'm looking at retail, industrial, single family, multifamily, office. They're all in different innings. So unfortunately, everybody lumps real estate into one big category. If you're looking at multifamily, I think it's early. If you're looking at office, I think we're, somewhere, a little more. And also, I don't see a huge crash on the residential side because of the inventory. The lack of inventory, but nobody can buy them. Well, they can, but we're all-time lows, and mortgage companies and everybody's scrambling. So I think, but it could be interesting to see. I think we got to wait. But office buildings, as I said in my video, is going to be the first domino to fall, and it's already starting to show up.
But you also, even though you're saying you don't see a huge correction in multifamily, you still don't think somebody should buy something if it's not cash flowing.
Correct. Right. You got to start with cash flow, and who the cash flow comes from the tenant. So who's going to be your tenant? That's the most important thing. The tenant is going to become very, very, very important here. Well, they already have been, and they already are, but now that's going to be, in my opinion, that's going to be your deciding factor. So even if you buy a warehouse, as we were talking with Shannon, one of the members of the collective, he just bought some warehouses in Houston. The biggest issue is the credit of the tenant and how is their business doing. So, it's one thing to throw one in there, but if their business is not doing well and their business is going to suffer from inflation, then you're not going to do well. So that's why the tenant is going to be really, really, really important moving forward. The tenants that have jobs, if it's single family, or if it's Airbnb, who's going to spend $300, $400, $500 a night or $200 a night? I don't know.
Yeah.
That's what you need to be watching, because that's the income.
Right. Yeah, and just not getting, like we were saying before, not getting desperate on trying to make things work, Like even with the land lease, the other realtor was saying, well, you can Airbnb this property and, you can make all this money. So $675 is not a big deal, because really the rents on that is probably about $3,500 to maybe $4,000. So $675 is a big chunk. But if you Airbnb it, you can make $10,000 a month, and everyone's doing that. And I'm like, well, is that why there's 5 for sale in the neighborhood?
In that block.
Yeah. And we do know that Airbnb is having some significant issues, because obviously in a recession, people aren't traveling, and obviously the inventory has went up.
Yeah, it's gone up a lot. And I actually think that would be an interesting play, is to find people that are in trouble on Airbnbs, because they've been rehabbed, they've been rented, they've done pretty well. But, that would be a target. If I were you guys, I would look after. That's a good point.
You can almost go on Airbnb, see places that aren't rented that much, because you can see how much what dates they're rented, and then reach out. Because I know for a fact in Scottsdale, there's a lot of Airbnb people that are in trouble right now.
Yeah, there are. And that's happening in a lot of places. And some areas are doing fairly well. But that would be a great one, because then you can go in and snap something up. It has to work. long-term renter, it has to work, but it's not a bad strategy.
Yeah, absolutely. Well, make sure you guys get your Limitless tickets. They are on sale. Limitless is in about a month. It's going to be a lot of fun here in Scottsdale. And
and we got a happy hour on the 1st of June. It's
definitely going to sell out.
Don't forget. Yeah, we got that. And we got a happy hour on the 1st of June. So you're going to want to join us for that. But the Limitless tickets, limitlessexpo.com. Going to want to sign up for that. We still have, I just checked this morning when I had a call with Tarl this morning. And so we're not quite sold out. I know last year we sold out.
Yep.
So there's still some available.
Awesome. Well, you guys have a good week, and we will see you next Monday.
Okay. See you guys.